Hi everyone and welcome to our channel Market Minute. And today we will talk about the Silicon Valley Bank crisis. Let me begin with some background information on the SVB. Silicon Valley Bank is a startup focused bank and it has several business lines that are all connected closely with the startup world. SVB was the 16th largest bank in the United States at the time of its failure on March 10th and the largest bank in the Silicon Valley in terms of deposit. Other than taking deposit from startup, it also provides banking, venture debt, and other loans to venture capital firm. It also invests in a number of venture funds as well as tech and healthcare startup. On Thursday, March 9th, the stock price of its parent company, SVB Financial Group, fell by 60%, causing a surge in deposit withdrawal of $42 billion and a steep decline in the value of its holding, eventually causing the bank to collapse. How this issue occurred and where it all started. For this, we must return to 2020 when the interest rates are nearly zero and the venture capitalists are investing in different kind of startups since the money is easily accessible in the zero interest rate environment. When this investment comes into startup, they deposited it in Silicon Valley Bank so that they can use it whenever they need it. During the same period, SVB deposit tripled and it is now liability for them as it owes to the depositor. Instead of lending to high-risk startup, Silicon Valley Bank invested in government-backed assets such as US Treasuries and mortgage-backed securities of around $80 billion. However, these fixed income investments have a 10+ year of term. Before we proceed, the viewer must understand that bond price move inversely to the interest rate, which means the interest rate rise, bond prices fall. The Federal Reserve raised the interest rate by 450 basis points in the last 1 year. This makes it very difficult for the startup to raise fund and it started operating its business with the existing fund. When it requires the existing fund, it started withdrawing it from the SVB. In the meanwhile, the amount deposited in the fixed income securities by SVB started showing a sharp decline in its value. As a result, the SVB was forced to sell those assets at a loss to repay those withdrawal. And the bank revealed unexpectedly on March 8th that it had lost more than $2 billion. On Friday, 10th of March, the tech and startup focused lender was ordered to shut down by California regulations. And it was asked to keep it under the control of Federal Deposit Insurance Corporation. According to FDIC, the bank had $175 billion in deposit and $209 billion in asset at the time of bankruptcy. More than 93% of SVB domestic deposit were uninsured at the time of last year, despite the regulator normally protecting the account up to $250,000. Where did they go wrong? I could see how their portfolio concentration and operational risk in a high interest rate environment contributed to the bank to collapse. Meanwhile, Elon Musk has stated that he is open to the idea of purchasing the collapsed Silicon Valley Bank and transforming it into digital bank. What do you believe caused this collapse? Do you believe Elon Musk will be able to turn this into a digital bank? Let me know in the comment section. Thank you so much for watching this video. If you enjoyed it, please hit the subscribe button and press the bell icon below. Thank you.